So alright guys, IAS 10 event after the reporting period. This is our first topic of the day. This is a very interesting topic. Events that can happen after the reporting period, but still maybe you need to do some give some reaction based on that events and amend your financial statements or disclose that event in your financial statements. Sometimes you need to write off your assets in the financial statements, though the event is happening after the year end. This kind of event are discussed in this IAS. All right, so first of all, we're going to discuss here what is an event after the reporting period. This is an event that occurs after the reporting period end. This is our reporting period and I have drawn a timeline for you guys so that you understand. So the event occurs after the reporting period end, but before the financial statements are authorized for issue. So event must occur between these 2 days. Okay. After the authorization of financial statement by the executive director or management team of the company, there can be further events, like it can be submitted to the shareholders for approval, it can be submitted to the supervisory board or to the entities, it will be issued. Those will happen in the later date. But we are not talking about those dates. We are not talking about the date the financial statements will be given to the shareholders for approval. We're not talking about that date. We are talking about the date on which the financial statements are authorized for issue. So the event must happen within these 2 days. If the event happens within these 2 days, then this will be covered by IAS 10. Otherwise, this will be outside of the scope of IAS 10. There will be no discussion about that event under this IAS. This IAS principle cannot be applied on an event that occurs anywhere else other than over here. So event must occur over here. Now the objective of this IAS is to prescribe how an entity should react based on the events that may happen after the reporting period. How the entity should react based on the event that may happen after the reporting period. Whether it needs to adjust the financial statements, update the financial statement to reflect the new information gained from the event, and whether it needs to make a disclosure without making any amendment to the financial statements under consideration. So sometimes entity needs to adjust the financial statements. That means we will call the event as an adjusting event, and sometimes entity will not require to make any amendment to the financial statements. Simply they need to disclose the information into the financial statement. Those events will be called non-adjusting events. So we will have 2 different types of events, adjusting and non-adjusting event. That being said, let's go and check the definition of adjusting event. So adjusting event is an event after the reporting period that provides additional evidence of condition that existed at the reporting period, at the end of the reporting period. So this is the main thing. It provides additional evidence of condition. Additional or further evidence of condition. So the condition must be there at the end of the reporting period. Something is there that needs correcting, that needs amending, that may not be right. That kind of evidence we are receiving from an event. Okay? Think about it. A fraud is committed in 2019. Fraud is committed in 2019. But the fraud is detected in 2020 by the auditors. So the condition exists at the end of the reporting period 2019. So this event will be an adjusting event, and we need to adjust the financial statements of 2019. Now the second type of event, which is non-adjusting event. Okay, so these non-adjusting events are events after the reporting period that provides indication of condition that arose after the reporting period end. After the reporting period end. Condition arose after the reporting period end. Once again, auditor detected a fraud in 2020, but the fraud is committed in 2020, not within 31st December 2019. It is committed in 2020. So the condition arose after the reporting period end. Then the event will be called non-adjusting event. Of course, for non-adjusting event, we are not going to adjust our 2019 financial statement. Rather, we will make a disclosure in 2019 financial statement if the event is material. Yes, if the event is material. Look, a fraud is detected which happened in 2020. What is the financial impact? Because of that fraud, $20 million is lost from the company's fund. Okay, nature and also financial effect. If you can quantify that, you need to disclose that. In 2019 financial statement, the fraud happened in 2020. Non-adjusting event disclosed as it is material. Now we will examine some of the situations, and I'm going to ask you a question. You need to think carefully, and you will have to try to reply me. This is our first example. During the reporting period, entity had a building. The building was in good condition. The building showed good value, like say $5 million value in the statement of financial position 2013. After the year end, means in first few months of 2014, that building is severely damaged or destroyed by fire. It can be flood, earthquake, whatever that is. The building is seriously damaged or destroyed. Now my question is whether this event is an adjusting event or non-adjusting event. Should I remove the building from my statement of financial position on 31st December 2013? Should I reduce the value of the building in my statement of financial position as at 31st December 2013 or not? Who can give me an answer on this? Anyone?
So this is a non-adjusting event.
Non-adjusting event. How is that?
Because during my year end, like 1st Jan to 31st December 2013, this event is not happened. This happened after our reporting period.
Okay, condition was not there. We would say rather condition was not there, because if I say event did not happen, like adjusting event can happen after the reporting period end. That's why the name is event after the reporting period end, right? So we can say the condition did not exist at the year end. Thank you very much. It is non-adjusting event. Now I will go to our next situation. This is an example, a litigation. There was an ongoing court case against your company during the year ending 31st December 2013. And only after the year end, the verdict is given. And maybe you are fined by $20 million. Now the question is whether that is the verdict that is given is adjusting event, non-adjusting event. Do I need to reflect anything in the statement of financial position that is prepared as at 31st December 2013?
Yes, sir, we need to adjust this event because it has the condition arise from before. We knew about the litigation. It is not something that arose from after the year end.
Right.
Before, since it was a provision should have been kept against this condition, and since it is confirmed, we should adjust the event from the provincial to the actual amount we have to pay.
Thank you very much. That's wonderful. We already had an obligation over there, present obligation. We have done something wrong. present obligation. The obligation is confirmed by the verdict of the court, but the obligation was there. We have evidence, we have a present obligation, we need to recognize provision. If we had already recognized the provision, maybe we need to amend the amount of provision that we have recognized based on our estimation. Now the amount is confirmed. So the confirmed amount we can put in 31st December 2013 financial statement of financial position as a liability. Thank you very much. Now the next event. On 31st December 2013, you had inventories and you are showing that in your statement of financial position. Yes, inventory like value per unit, maybe $100 only. Now, after the year end, you are selling that inventory at 70% discount, maybe for $30 only. Selling for that inventory that you had in the statement of financial position. Now someone else give me this answer. Hasif Ahmed, what do you think? Use your brain and give me an answer. Is it an adjusting event or non-adjusting event?
So this is non-adjusting.
Non-adjusting event. How so?
Because during our reporting period, our condition was we are selling $100 per unit.
No, we're not selling. We had that value in our statement of financial position.
So this event, this condition arise after the year end.
After the year end.
So we can this will not affect the current presentation.
Okay. So we got one answer. Maqsudur Robin.
It's an adjusting event.
Adjusting event. How so?
কারণ ওই রিপোর্টিং পিরিয়ড অফ রিপোর্টিং এর মধ্যে এটা যদি $30 সেল করা হয় আর এটা যদি রিপোর্ট করা হয় ক্লোজিং ইনভেন্টরি 100 করে, তার মানে হচ্ছে এভিডেন্স দিচ্ছে যে তখন ভ্যালুয়েশনটা ঠিক ছিল না।
Well, now we have IAS 2 and IAS 2 says inventory should be valued at the lower of cost and NRV. And what is NRV? NRV actually future estimated figure, right? What we are going to sell the inventory for and what is going to be the selling cost. Based on that we calculate or we predict NRV. Right, we predict NRV. So at the statement of financial position date, we are valuing this inventory at $100 means our predicted NRV was at least 100 or more. Otherwise, we cannot value $100 per unit inventory. That will be a violation of IAS 2. Now later, after the year end, when we actually make the sales, we now know actually it's wrong. So we need to reduce the value of the inventory. Inventory is overvalued in the statement of financial position. Condition exists at the year end that the inventories are maybe impaired. This is about investment in share. You had purchased some share. At the year end, those shares had market price of $5,000. Say, traded, at the year end. The market was booming. But within few months, when the time of authorization comes, you notice that those shares worth only $20 piece. $20 a piece. But you are showing in your financial statement 5,000. When you try to authorize, sign the financial statement, you see, should I sign this financial statement or not? Is everything all right? Or should I change the financial statement? That's the doubt in your mind. Can you tell me whether this is going to be an adjusting event or non-adjusting event?
I think it will be an adjusting event as the share they had the share.
Okay.
And share price have dropped.
Russell Rana, do you have any opinion on this?
Sir, I think this should be non-adjusting as there wasn't any indicative condition. So I think this will be non-adjusting.
Thank you very much. You are correct in your judgment. This should be a non-adjusting event. Share price had fallen because of market crash or because of some other reasons, after the reporting period end, at the reporting period end, share price was $5,000. And you can support it. If auditor complains or any other party complains, you can face it and you can support it. You can show the evidence, market quotation. Look, share price was 5,000 and I'm showing that. The condition arose after the year end, whether we will disclose or not. Non-adjusting events will be disclosed if the event is material. Now the question is whether this event is material for your company or not. It depends on company's size. Depending on that, you will decide whether it worth disclosing in 2013 financial statements or not. Okay, we're talking about 2013 financial statement. Of course, the loss must be reported in 2014 financial statements. Hope that makes it clear. Next example. During the year end, at the year end, you had receivables. Yes? Piled up receivables in your statement of financial position at the year end. Say you had $50 million receivables at the year end. And after the year end, a customer went bankrupt, owing you $2 million on the reporting date. So on the reporting date, you had a receivables of $2 million from this particular guy. $2 million over there. The question is whether this is adjusting or non-adjusting event. Baki Billah?
Yes, sir.
Yes.
So this is a non-adjusting event because there were no proof that the customer would go bankrupt before the year end.
Okay.
Since it is an event that occurred after the end, it would be non-adjusting.
So any other opinion on this particular topic? Any other opinion? Free for all. Anyone take it? Do you all agree with Baki Billah already?
I agree.
You agree, okay. So looks like you all agree with Baki Billah and there is no different opinion. Actually, this is an adjusting event. Going into liquidation, insolvent liquidation means this particular company or person had financial difficulty, and financial difficulty continues for a while before a person or company applies for liquidation. This entity had financial difficulty over there. Difficulty. So, IFRS 9 requires us to create allowance for bad debt, right? Allowance for bad debt based on expected loss. Expected loss. Loss did not happen yet, remember. Loss did not happen yet at the year end. But IAS requires you to create some allowance for bad debt. So my allowance for this receivables now must be reviewed and we need to update it as necessary, or we can write off these receivables. Maybe my allowance for this particular receivable at the year end was not correct. That condition exists. This company had financial difficulty at the year end and my adjustment for the allowance may not be correct. Now I have additional information. I can go back and correct it. Before that, I didn't have this additional information. All right. During the year end, you sold a car. So the price was not negotiated properly. And the price is determined only after the reporting period end. You had made the sales at the year end. Mated proceed maybe $1.1 million, and later the price is determined after the year end from negotiation and everything $1 million. Now tell me, who's going to tell me this one?
I think it would be an adjusting event as the car was purchased. It can occur.
Right. Thank you very much. Thank you very much. Now I would say, wait a minute. I had estimated figure, not actual, estimated figure in the year end, right? Now I have the actual amount. correct amount. So I don't need that estimation anymore. Let's go back to the financial statement and correct it. So this is a sales transaction. Same can happen for purchase transaction. You have purchased an asset during the reporting period, but the price is determined only after the reporting period end. Same, it will be adjusting event. Thank you very much for the right conclusion. Now the next example. A fraud was committed during the year end, but auditor detected the fraud only after the reporting period end.
Sir, this should be adjusting event as the fraud committed in the reporting period, and there is further evidence regarding that.
Right.
So I think this should be adjusting.
Perfect answer. Perfect answer. The condition existed at the reporting period end. Our next situation is like this. During the year, this 2013, company made a profit of $100 million, and company declared a dividend on that profit. Dividend on that profit, 2013. But the declaration is made in 2014 after the reporting period end. Is it an adjusting event or non-adjusting?
I think non-adjusting.
Non-adjusting event. Right. Why so? This is non-adjusting event because the liability arose after the year end when the declaration is made. In order to record dividend payable, we must have to have a present obligation. That's the definition of liability. What is a liability? Present obligation. Now the question is, did you have any present obligation, any contractual obligation, any constructive obligation, any legal obligation in 2013 or not? The answer is you didn't have any obligation to pay dividend in 2013. Company is not legally bound to pay dividend if it makes profit, right? It's a decision of the directors whether company will pay dividend or not. When directors make the decision and makes the declaration, at that point liability arose, right? So the condition arose after the reporting period and it is clearly a non-adjusting event. Remember that. Next one, similar type of thing. Company made again $200 million profit in 2013, that reporting period, and company had declared bonus, like company had given bonus target during this year to the managers and directors. If we make a profit, you will get a bonus of 10% of profit. That target was given to the managers. Managers worked hard, directors worked hard, and they made a profit of 200 million in 2013. But the bonus amount was only determined, right, calculated and determined and settled after the reporting period end. Bonus amount was determined and communicated. You will receive this much bonus, you will receive that much bonus after the reporting period end. Can you give me an answer on this, whether this should be an adjusting event or non-adjusting?
It should be adjusting because the condition given in 2013 and the bonus calculated based on 2013 performance. That's why.
Right. Thank you very much. So what's the difference between this one and previous dividend one?
Previous one is that was a decision made in after the reporting period. So condition was not in there, no obligation to give the dividend payout.
Right.
Because it is totally.
Thank you very much. Company does not have any obligation to pay dividend on the profit. But this time, company had an obligation as soon as they made the profit. As soon as they made the profit, the obligation, present obligation of company has arose. Thank you very much. Very good answer, Hasif. and good explanation also, I would say. And Maqsudur Robin, you are correct also. Thank you very much. Adjusting event. Yeah, very good answer, Maqsudur Robin and Haseb, both. So you already know that, right? You had a good discussion on events, adjusting events and non-adjusting events. Now you already know what you need to do, right? If you have adjusting event, you need to correct the financial statements under consideration, means you need to adjust it based on the additional information. And if you have non-adjusting event, of course you are not going to touch the financial statements, right? You are not going to amend any figures in the financial statements. However, you will make a disclosure if the event is material. If the event is material. So disclosed only if the event is material. Going concern issue. IAS 10 also talks a little bit about going concern issue. This is the fundamental assumption of preparation of financial statements. We assume that company will be going concern, means company will keep in existence for at least 12 months, for foreseeable future. Actually, the word is foreseeable future, as far as you can see. If you can see 5 years, company is going to survive. If you can see 7 years, company is going to survive. That's what you are seeing right now, foreseeable future, right? The going concern assumption can be sometimes hampered. It can be invalid if the management team has decided to put the company into liquidation. It's their decision, maybe voluntarily, because of some reason they want to liquidate the company. Then we would say that the company is no longer going concern. Or something very bad can happen after the year end, like coronavirus affected the whole country drastically, and your shop is closed for several months, months after months after months. You had many shop outlets, and now you are forced to go into liquidation. There is no realistic alternative open in front of your company other than going into liquidation. Then you will determine that the company is not going concern. Now what you need to do, you need to go back to your 2013 financial statement and prepare that financial statement on breakup basis, right? Going concern basis financial statement preparation is not valid for 2013. Finally, we will talk about some of the disclosures that are required by IAS 10. The first disclosure, date of authorization of the financial statement. This must be clearly disclosed so that we have a good understanding events within which day and which day are covered by IAS 10 and which of the events are not at all covered by IAS 10. For that clear understanding, the date of authorization of financial statements must be provided.